Rajeev, welcome to the Equitymaster Mint Investor Hour. Delighted to have you. Uh, I'd like to kick off this podcast session by asking you about your really the early stages of your life. So, if you can tell us a little bit about where were you born and you grew up, and also a little bit about your parents and the environment in your home with regards to what kind of a about money. Was it were they investing, not investing? Trying to get a feel of where you came from.
Sure. So I've been born and brought up in Mumbai, so been a Mumbai boy all along. So including studies and career, I've never stayed outside of the city for an extended period of time.
Okay.
Most of the life in the early part was in and around the western suburbs of Mumbai and within a 2 to 3 kilometer radius. So nothing much to talk about in that sense. So these days we have all communication which comes to us electronically. In the early days, it was a era of paper communication. So my father was an equity investor since early days, although the amounts are not very large, but he was a serious investor in terms of doing fundamental investing in groups that he thought were well run. And although it was not a very sophisticated approach, but it was fundamentally investment driven approach and not a speculative approach.
Wow.
So I grew up with these annual reports coming by post
Wow.
to home. So that was where I got familiar with equity as an investment class. Also, there is this thing called spirit of the times, right? So my graduation year was 1992.
Superb.
And that was the period of the equity boom, the early days of liberalization after a tough situation of being virtually bankrupt. So today, just like everyone would rush to a startup or a AI company, at that time, people of my age would have this
The stock
attraction
market.
towards the stock market. So that's where I am.
Wonderful. So one thing that intrigued me is when you mentioned that your father was doing some form of fundamental analysis, because typically when I'm talking to guests on the podcast, I'm typically hearing that they were investing in IPOs, right? That was a common theme those days, or there were some stray investments, or some family member told them. But I'm pretty amazed. Did your father have any? What was he professionally? What was he doing? Did that give an exposure that he should look at numbers, etc.?
I don't know how he actually managed to get into the field, because even in the family, other relatives or elders would tend to look down upon stock investing as something like a gambling thing or stuff like that. But one good thing about my father was that whichever subject interests him, he would end up picking up one or two books on that subject matter and just skim through it, make those notings and try and figure out what the field was about. So, like, he had interest in photography at that time. Today, not so much. He's not into photography today, but at that time, he would buy books on photography, and those were the days of the real camera. So what kind of lighting, what kind of angle. Similarly, for investing, he had a couple of books. Now, these were not the probably the best books he could have picked up. So these were not the Benjamin Graham kind of books. But nevertheless, they spoke about what is the equity base, what is the total market value of a company, what is earning per share. So some very, very basic things were there in those early books.
Wow. I wonder who picked up that trait of digging deep into ideas. Okay. So you said you graduated in 1992. That would be your bachelor's
That is correct.
and
Bachelor's of Commerce.
commerce. If I may ask, was it Jayant or I remember?
Narasimhanji,
NM.
Vileparle.
NM. Okay. Those are that's the 2 kilometers you were in, the radius. Okay. So you did your graduation, and then what did you do after your graduation?
So the messaging was clear that whatever you want to do later on, first get your academics right. And it was not that immediately after graduation I had a pathway to uh, join a mutual fund or investment bank. So one had to get the academic credentials correct. So I pursued my chartered accountancy after that. So that was the first time I ventured outside of the 2 kilometer radius. The office was in the street called Ambadal Doshi Marg, which is parallel to Dalal Street, overlooks the BSc. That's where my audit firm was. So 3 years of chartered accountancy, 2 years in the audit firm BD Chokhakar and Company. And the third year, chartered accountants have the option of working for a corporate, and it's called industrial training. So the third year, I moved to an investment bank to do my industrial training, and started doing things like proofreading the IPO prospectuses and stuff like that.
Oh, that's a pretty straight path, huh?
Yeah, the interest was in that field. So rather than stick around doing one more year of audit, went to where my calling was in terms of
I can
financial markets.
almost speculate you were primed for it, because in your home you had someone who's like reading, digging deep. Then you had this whole Harshad Mehta. Harshad Mehta 92 was, of course, the crash as well, but the whole build up to it was kind of fascinating if you did your homework. So yeah. So in this period, before you became a professional, a stock picker, analyst, when did you actually get around to making your first investment?
The first investment was, I would think, in 1995. So
Okay.
before that, there was no investable surplus. So at that time, audit trainees, the article clerks, as they are called, would get 235 rupees as the monthly stipend. And even at a discounted rate for the railway pass, it would not cover the commute. So most of the money would go there. There was no investable surplus. That only came in 95, and that's when investing started.
They made you ensure that you are investing a lot in the studies, so you have to do well. So 95. So if you made your investment in 95, that's the whole IPO boom is on.
So IPO boom has come. It has started wobbling, crashes. So again, it sounds very romantic. 92, you graduate and move towards financial markets. What you have to remember is 1992 to 2003, the markets kept going up and down, and more down than up. So it was a lost decade for the Indian financial markets. And at the end of 11 years, you were scratching your head, where did I come? Meaning, was it the right decision even to come to stock markets rather than do plain vanilla audits or taxation and stuff like that?
Yeah. I think I don't know, and maybe you can shed some light on this. But this has happened across the world, right? Where there's a decade-long period where if you've not timed it to perfection, you could come out at the other end of 10 years with nothing. And that can be pretty painful experience. And then I think there's all those famous studies, right? If you miss the the highest return days in a decade, the returns would be almost nothing. And I guess that's what that period turned out to be. If you missed the 99 surge and did not exit after that, or if you missed the 2000, I think 1994 also had a surge and did not exit, you could have ended at the other end with not much returns.
Yeah, so 99 was more in a select set of stocks. So it was all about ICE or TMT.
TMT,
yeah. So technology, media, telecommunications, or information, communication, entertainment. Those kind of acronyms were floating around, and new economy versus the old economy.
That's right.
And stuff like that. So it was a tough period. That was the decade when a lot of companies got founded, which went on later years to become great wealth creators. But while living through it, it did not seem easy. So you had the Infosys listing happening in that period, or you had the banks like HDFC Bank and all create wealth, and you had the Kotak listing, which earlier was in the NBFC avatar and later on morphed into a bank. But yeah, so a lot of interesting companies came about, but yeah, living through it was not so easy.
Oh, yeah, I hear you. So let's stick to the timeline that we usually do. So 1992 stock market crash, you graduated, so you're aware of the situation. What impression did it create on you? The Harshal Mehta spike and the meltdown.
So one thing was clear that the manipulated stocks did not have longevity. So leaving aside the fact that temporarily it made a lot of people paper wealth, but that was not sustainable. So things which crashed and which came back were fundamentally sound companies, whereas companies which were clearly manipulated or did not have revenue and earnings behind them withered away. So that was a learning of that period.
Quality works out in the long term, basically. That's what you have to stick to. Okay. And 1995 or 94, 95. 94, I think the FII boom and the sell-off and then the IPO wobbling that you referred to. How was that period for you? Now you're doing your articles, you're doing your CA, more familiar with numbers.
Yeah, so as I said, 94, I moved to industrial training, doing the paperwork for IPOs, and 95 was when I cleared my chartered accountancy exam and became a full-time employee in the investment banking cell. So by that time, the IPOs had started petering out, and within the next year or two, by I think if memory serves me right, by end 96, the entire IPO market had been washed out. So there was absolutely no work to do in the department. You would show up at the office, but no company was going public and there was no due diligence to be done or no document to be drafted. So it was that kind of period.
And then, of course, we had the whole Asian crisis.
That's correct.
97, the 98, Russia went bust.
Yeah.
How did that phase play out for you? Leading on to then the 99 big TMP. Take us through the whole period, how your experience was and what were you doing professionally as well?
Sure. So 1994 to 2003, I was a jack of all trades. I cycled through various departments in the financial markets. So 94 to end 96 or mid 97, I was doing IPOs. Then for a brief stint, I was doing corporate finance, where the company that I worked for was raising money from lenders. So interacting with bankers and negotiating lines and managing the company's cash flow. So it was corporate treasury or corporate finance, as it was called. So this was mid 96 to maybe mid 97 kind of period, 1 year. And then I moved to bonds, government security bonds, interbank market. So as I said, IPO market was done and dusted. No IPOs were coming out and there was no work. And I was not enjoying the corporate finance bit because the company that I was working for had borrowed a lot of money and it was not a great situation to be in, to be continuously answering bankers and stuff like that. So bonds was a good place to be in. And at that time, the interest rates were very, very attractive for the investors, and that market was seeing a lot of activity. So that's when I moved to the government bond desk.
Okay. And you're still at the investment bank?
Yeah, the same company, the first employer. So
Okay.
even in 97, I was working with the same organization, but I'd
Okay.
moved from investment banking to corporate finance to the government bond desk.
Wow. Okay. So you're starting to get a pretty holistic understanding of money
Yeah,
from
whichever
both
way you
sides
look
of
at
the
it,
from
jack
both
of
sides.
all trades or lattice work of mental models, you can
That's right. So
pick up.
I think one of the most underrated things in this generation is the fact that a jack of all trades can create a model which may end up being far superior than someone who's specialized only in one field, right? So there are advantages, disadvantages, both, if you will. Okay, what happens next? 90s, 98 onwards.
So 98, uh, late 98 is when I get married.
Okay.
And just before my wedding day, or meaning a month before that, or 15 days before that, the company starts laying off people. I am not the affected party, but
Oh my
it's
God.
a
Yeah.
jittery environment all around.
Yeah.
So
Did your would-be wife come to you and have a chat?
no, so she was not aware of what was happening. So I didn't want to unnecessarily scare her, especially since I was not the affected party. But I said after things have settled down, it's time to move on to another company.
Yeah.
So I moved to another company in the same field doing government bonds.
Okay.
So I was doing government bonds till 2003. And 2001 was when I joined PPFAS on the government bonds desk.
Okay. So PPFAS, we want to talk about a little bit more. And one of the reasons I want to talk especially about that is I want to, of course, learn, understand and hear your story. I also want you to share with us, as we discuss, your understanding or your perspective on how Parag Parikh saw the world and what did he bring to the table. Because I think that's a story that is not very well told per se. Because I think maybe the capital markets boomed a lot after that, or whatever could be the reason. But I think that is the perspective that a lot of people could benefit from, because he really built a venerable research house, and that is metamorphosed into your mutual fund, which is, of course, it's right up there. So that's something we'd like to talk about more. But as we go along, so I want to just make a point on bonds. Now, typically, if I talk to Indian investors, bonds are boring. The closest they can come to a bond in those days was a RBI REIT bond, right? If you remember those days, I don't even remember the rate of interest, probably 8% tax-free or 9% tax-free. But bonds by themselves is a very large asset class globally. In India, still it's a closed market, a relatively closed market. But I see that even in your mutual fund, you've done something pretty innovative, is you're starting to pick out bonds of state governments, and you're finding yield opportunities, which all carry sovereign risk. So you're not really doing that. So what is your take on this whole bonds thing? And the whole world gets shaken when bond market shake. In India, if you turn on the morning news, they give one line to the bond market and it's back to the stock market.
Yeah, so the reason why no one looks at that market anymore is that we have had close to, I think, a decade or two where bonds gave hardly any real return. And for some time in a lot of markets, the return was negative even in nominal terms, leave aside in real terms. So why would anyone put money in a bond which was guaranteed to lose money for you? So you put in 100, instead of getting back 100 plus interest, you would get back, let's say, 98. Why would anyone put money there? The period I am talking about will almost sound like a fantasy to people today. So today, when longer term index returns have been around 12% from equities. 1997, when I joined the government bond desk, that time the 10-year government bond yield was 14% per annum, paid semi-annually.
Wow.
That time, Tata Steel and L&T, AAA names at that time, were borrowing money at 18%, and a AAA rated NBFC of that time, Reliance Capital, was raising company fixed deposits at 21% per annum.
Wow.
So it's really the time one is in. So if there's going to be an elongated period of equities going nowhere and being very volatile up and down, and where relatively low risk instruments are giving you high teen returns, why would one want to go to equities in such a period? It's only when rates fell very significantly and where yields were not attractive and the earnings multiples became very, very cheap in 2013, that the in 2003, that the attention turned back to equities.
Yeah. So speaking of bonds itself, I think one thing nice the RBI has done, and I think there's a long way to go. They've opened their RBI Retail Direct, where you can directly buy bonds. Now, I guess now all in the realm of speculation, if the yields become attractive again, then more retail guys can get to participate in this over time. We'll have to see how it pans out.
I'm not that optimistic, Rahul, on RBI's bond, and you have taken up a topic which incites passion in me, so maybe I'll spend a few minutes on this. The reason why the retailing efforts of the government periodically go nowhere is because they compete against themselves. So today, if you buy any government security as a retail investor, you are locked into a security where if you want the money back, you have to again come back to the market to sell it, and where there may be liquidity, there may not be liquidity. Also, you are carrying a price risk or interest rate risk. If after you have bought the securities, if interest rates rise, you may have to exit at a loss. Today, when 5 lakh rupees worth of bank fixed deposits are protected by insurance in terms of DICGC cover, and RBI stroke government will not let you fail. And in India, on bank fixed deposits, the investors have a free put option. You can any day go to the bank and say, give me a reduced interest rate, no problem, charge me some penalty, but give me my money back, and the bank will give you your money back. So in such a situation, why should anyone go to government securities is a puzzle. Also, most of the times, the small savings yields, which are again government securities, are typically higher than the rates on central government securities. It's only now that they are at more or less parity, but otherwise in most periods, the small saving rates are much higher for the retail investors. So again, they don't come to the tradable securities markets. So unless some of these issues are ironed out, I don't think that market will develop too much.
Yeah, that's a fair point. I didn't think about it on those lines. I was just thinking that someone's looking at zero credit risk, but then you make the point. You can go to the small savings scheme. They have the same credit risk as a treasury bond. Both are guaranteed by the government of India.
So and even till 5 lakh rupees, which would cover most investors, and you can spread that 5 lakh across 5 banks, then you have 25 lakh limit. So,
or you could go to an extreme. Last evening, we're recording this, of course, in the 3rd week of March. Last evening, I read about a company in the US which has opened 3,000 bank accounts and put money in it, so that if any bank goes bankrupt, their money is safe. So do the math: 3,000 into $200,000, assuming they're keeping a little buffer, that's like what, $600 million or whatever the number is. I don't know.
Yeah, so I think a lot of work needs to be done to popularize that. I think in the intermediate term, mutual fund route for retail investors makes a lot of sense, where it creates a lot of convenience for the investors to enter and exit relatively easily.
Yeah. Okay, so 2003, you were at PPFAS. Now, there are 2-3 major episodes in the next 20 years. There is this massive bull run which starts in 2003-4, takes off and peaks at 2007-8. Then we have that, what is that, the period called 2013 onwards?
Policy paralysis and
domestic policy paralysis, and globally you have that risk in the emerging markets and all that.
Taper tantrums and stuff like that.
Taper tantrum and all that starts. And then you have the pandemic. So take us through these 20 years and just tell us how it plays out, how, when you think about it, how it each played out, and how did you deal with those issues?
Yeah. So, as I said, 2001, I joined PPFAS on the government bond desk. And Mr. Parag Parikh, as we used to call him, he would take us out for dinner once a week, generally chat about what's happening in the marketplace and stuff like that. And 2003 is a period where we have been running portfolio management services for about 5-6 years. So we started late 7 years, close to late 96, we started our PMS services, and we are somewhere in early 2003 chatting about various things. So it tells me we've been running PMS for whatever 6-7 years, and the corpus has just grown to about 3.85 crores, sub 4 crore AUM at that time. This people are just not keen on equities because the markets have been up and down, and people are losing faith in equities. So I said, yeah, but it seems to be the best time probably to come to equities. And we were discussing the performance of debt mutual funds, and we were discussing equities at that time. So debt funds had given returns of close to 20% per annum to retail investors. And there was so much love for debt funds at that point in time, and you could do no wrong buying debt funds. So I mentioned that government bonds were 14%, AAA bonds were 18%, and all that. So anyone who bought those bonds not only got the coupon rate, but because interest rates started falling, they also benefited from the bond prices going up. So there was dual benefit for the investors. So while chatting, I mentioned to him that most of the juice over there seems to be sucked out because yields on 10-year government bonds, if I remember correctly, were close to 5%, 5.5% per annum. And at that time, the expense ratios on debt mutual funds were higher than what they are today. So maybe 1.5%. So I said, out of 5.5%, if you remove 1.5%, that means return is 4%. And I don't expect rates to keep falling. They have fallen from 14% to 5.5%. There's not much downside left now that it's very close to inflation rates and stuff like that. He says, yeah, makes sense. Going forward, debt may not give much. So I said, but we also have an equity desk, and around that time, some measures were announced by the government on the tax policy front. So dividends were made tax-free. Capital gains were made tax-free, long-term capital gains after 1 year of holding. So, and at that time, a company like a Hero Honda, it was called Hero Honda then, there was a JV still going on. was quoting at 180 rupees and with a 18 or a 20 rupee come dividend kind of price, which is meaning 10% kind of dividend yield, which was tax free to investors. I said, here you have 4% return and investors will end up paying some tax on that. And at the other end, purely in terms of the current yield, it's 10% tax free and plus whatever growth they're able to pull off. To both of us, at the end of that conversation and over the next few weeks, we were chatting. To us, it felt like a no-brainer to shift from debt to equity. And by that time, things were so bad that almost all the people had left the desk. So in our team, we were left with no personnel in the equity team. So he asked me, would you want to work in equities? I said, yeah, sure, why not? And that's where I moved from the bond desk to the equity desk.
Wow. So and a brilliant call at that, right? You had a fundamental reason for it, and I think you can actually play out the stock market cycles basis the interest rate cycles to a large extent.
And so there were two great timing calls in the career. So I joined the bond desk right when interest rates were at their highs and the bull market was about to start, and I exited and entered the equity market right when the equity was about to take off.
So you went there on the equity desk. You started doing all your Hero Honda stuff, etc. And the next 4 years was superb, I would imagine. And at some point, it tips into irrationality.
Yeah, next 4 years were great for the stock markets in general. For me, the first 3 years were great. Fourth year was terrible for me. 2007 was terrible.
Let me guess, because you exited early?
Or... No, because I was not buying the stuff that was
on sale, yeah.
Working in the marketplace. So the sectors that were in fancy were real estate stocks, infrastructure stocks, and commodity stocks. And we were not participating in those three sectors at that point in time. So we did not have the DLF and Unitex of the world, or GMR, GVK, Lanco. Neither did we have the commodity companies, which were in iron ore and So 2007, we were underperforming the index by a substantial margin.
Yeah, but I think so in this phase. So let's say 2000, you're sitting with Parag Bhai and you're telling him, that makes sense. This may be a good time to do equity. So you're already thinking about equities by now, a lot more than what you're used to. You're trying to get a model in your head. This is how things should be. And why aren't they like this? And you're trying to come up with a high conviction idea. Now you've entered probably one of the biggest bull markets anyone will see. And you're riding that. You ride it till a point of rationality. And then you're saying, okay, I'm going to stay away from these sectors. You are 4 years on the equity desk. You don't have a whole ton of background on equities. So what was the process that led you to make that call? What did you develop? What kind of mental models, what kind of process you had developed by then that gave you that conviction to do it? And how did you convince Parag Bhai about that? Tell us both the sides.
Sure. So one is, I was not alone. So with me was another colleague of mine called Nirjar Handa, who passed away a few years back, but he was a few years younger to me. So two of us were running the PMS desk at PPFAS. So there was a person who was a mentor to Parag Bhai as well as a mentor to the research team. And he's been a mentor to a lot of people in the stock market. His name was Mr. Chandrakant Sampat. So he used to come to our office and talk to us about how to look at different managements, how to look at different sectors, what to look for in the balance sheet and in the P&L account and stuff like that. So he was very, very grounded in terms of the fundamentals of the company. And Paraguay also had seen various cycles in his career. So he had, in fact, he had gone through a similar phase in late 90s, where he was not in the then fancied sector of TMT, ICE, and where just because a company changed its name to something which was a .com kind of name, the stock price would run away. And obviously, he could not recommend buying such a company, or he would put out a sell on such a company, and the stock would continue running away. So he, around that time, he said, "Let me take a break." Nothing seems to be working. So that's where he pursued uh, his study of behavioral finance and stuff like that. So he had seen multiple cycles in the past, and he knew that these things come about. So 2007, we had pressures on two fronts. So one is newer clients, the clients who had come in, let's say 2007, they saw that we were lagging the indices by a huge margin. So they were getting restless. And some of my colleagues who were relationship managers to those clients, or whose job was to actually go out and meet people and try and convince them to become our clients if the wavelength matched.
Yeah.
Those people were saying, what are these guys in the research and investment team doing? All these new age companies are coming, and land bank and infra and all that, and these guys just don't seem to get it. So that's when I had the support of Paraguay, and he said, these things keep coming and going. You can't just go behind what is fanciful and leave behind the basic principles of management quality, balance sheet quality, competitive advantage, and return on capital and valuation and those kind of things, just to chase a stock which is going up. So he stood behind the investment team, and things worked out in 2008. So
it's typical, Rajeev. You said that you were Chandrakant Sampath was coming and talking to you guys. So you had a voice of sanity. You're mentioning Parag Bhai had seen this before, been there, done that, so he was supportive. What gave you the conviction? You're telling me people who reinforced your conviction. What gave you the conviction?
So a lot of reading. So by that time, in that period of 2001 to 2006, 2007, that period, I had gone through all the books, the usual suspects, Buffett letters and books on Buffett, Benjamin Graham, Peter Lynch, the usual things in terms of market mania, so extraordinary popular delusions and those kind of books, madness of crowd. So although my own experience was not in terms of managing professional money, I had understanding of the history. And another piece that I left out so far in our discussions is that although in my earlier organization, I was not managing equity investments, or I was not a fund manager, but I had seen what had happened to their prop book. So
1995?
1994 onwards.
94
so
onwards,
the organization I was working for was a big prop trader on its own account. And there I had seen the effects of leverage, the effects of getting in with management which is not really up there, and those kind of things. So I was aware of the 92 boom bust, the .com boom bust. I'd seen those cycles. So although professionally 2007 was the first cycle where I was managing money for others, but otherwise I was aware of the past boom bust cycles.
So it goes back to that thesis, right? You don't have to make all the mistakes yourself. You can learn from the mistakes of others. You can read the books, you can absorb the learnings, learn from the mistakes of others. And you've been very close to it, in the sense you were in the firm which was doing all this prop trading and all, and so I guess the learning in that is, of course, you study history, internalize it, and then believe in it, right? The reading for the sake of reading and then not acting on it not going to help you. You have to make those thoughts your own, ideas your own, and do it. So then, of course, you were proved right. 2009, by 2009, everything was done and dusted.
2008
Infrastructure,
itself, yeah.
2008, real estate stocks, infrastructure stocks, all these had got wiped off. Yeah, and a huge destruction of wealth. So I'm sure your portfolio performance was
Yes.
back to where you're used to being.
Yes.
Then what happens next? So you passed your first test as a proper equity manager with flying colors.
Yeah. So then for a few years, it's business as usual. We keep managing equity investments and things like that. And that was the time where the earliest signs start coming in, where Parag and I have a discussion where we feel that PMS may not be the best vehicle going forward because of certain changes which have come in, which could come down the road. At that time, for us to onboard a client, the client had to invest a minimum of 5 lakh of rupees.
Okay.
Now, this 5 lakh was increased to 25 lakhs and 50 lakhs later on. So there were early signs that the entry amount would be increased quite a bit. So that was a challenge in terms of immediately a large section of the client base has a problem getting onboarded with us. The procedurally things were becoming difficult in terms of opening so many bank accounts, so many demat accounts, so many custody accounts, brokerage agreements, reconciliations, audits. So if you are managing 10 accounts, 20 accounts, that is easy. But when it number starts going into hundreds, then that's when operationally things start becoming difficult in the PMS structure. So for various reasons, around that time, we felt that we should explore the possibility of setting up an AMC. So yeah, I think we started work on this in 2009. It took us 4 years to actually operationalize it.
Yeah, it's time consuming for sure. So okay, so we'll talk about the pandemic as we go along. Now I may be wrong on this, but I'm going to sort of still ask that question with an assumption. So a lot of people have in their investing stuck to the old Warren Buffett style of investing, which is buying the deeply discounted stocks and waiting for the prices to correct. At some point in time, at least I felt when you all started investing in a mutual fund when it was public, that maybe at the same time as Buffett or a little later, a little earlier, I don't know, you had already moved to buying a good company at a fair price logic and then holding it on, and because the world had changed or something had changed. So talk to us a little bit about that. What your whole thinking and thought process is and what you believe it to be now. What is the right approach in your view?
So in my days as an individual investor, and I mentioned that first investment was probably in 95. At that time, I was a person buying cheap stocks in terms of low P, high dividend yield, where statistically you could say that this is undervalued. But the person that I mentioned, Mr. Chandrakant Sampath, he was always a quality investor. So I think he was Manga's age probably, and he was in that kind of mold of thinking, and in terms of frugality, someone like Buffett. So he was always in the quality camp. So from 2003 onwards, I was exposed to high quality all the time. So I still retained some of my fascination for extremely cheap stocks, but the importance of quality was drilled fairly early on. And one realization which I had pretty much early in a few years' time, since I began managing money, is that in the Western countries, at least you can be an activist investor, or you can support some activist investor to either change management or to throw out cash or to spin off loss-making divisions. In India, nothing doing. So you have three categories of promoters. One is the government of India for the PSUs. Second is MNC subsidiaries in India. And third is the Indian business families. And almost all the three categories, they are the dominant shareholders. And you have to go with what they are doing. You can't do much in terms of changing how the companies run. So a lot of times, if you buy a badly run company, which is undervalued, where let's say your estimate of intrinsic value is 100 and the stock price is 50, what will happen is the intrinsic value will fall from 100 to 50 and below, rather than the market price going up to 100. So it's always better to buy well-run companies where your estimate may be 100 and stock is available at 90, but over a period of time that 100 will go to 200 and your stock price may go to 200 or beyond. And that is far better than buying a badly run company and waiting for something to happen.
Yeah. So you came upon this idea primarily because in India it's difficult to effect change in management. So for different reasons, but you came onto the same idea. And just for our listeners and viewers, Chandrakant Sampath was, of course, very popular for his large holdings in the MNC stocks. I think Procter and Gamble, Nestle, and stocks like those, which are very high P, but they still delivered year after year. And they gave
high P not at that time, Rahul. So
can you refresh our memory in what it used to be those days?
So companies like Pidilite and Marico were 10, 11, 12 times earnings in 2003. And levers and all would trade at maybe levers, Nestle's would be at 20 times earnings or 25 times earnings. So they were higher than the commodity companies like Tata Steel and all that, but nowhere close to where they trade at the current valuations. And in fact, he was a long-term holder and he would own companies for a very, very long period of time. But I remember when HUL had shot up quite a bit, and a lot of the earnings growth was because of M&A, where they had merged Brook Bond and a few other companies. He felt that valuations were not sustainable and he had exited HUL at one point in time.
Oh, wow. No, I don't think many people know that he was also someone who would exit if the valuation was high. People usually think of him as purely buy and hold. Okay, so you spoke about that, and I think, man, thank you for sharing that whole about paying a fair price for a good company, because I think that's very important, even more so in the Indian context where we've got all these additional risks. Let's talk about the pandemic. When did you first hear about something going wrong in the world in terms of a pandemic?
Feb 2020.
February. You did not have like an early signal in early Jan, late December 19? No. And how did you? What was your reaction? What do you think?
I underestimated the impact it would have on the world. So what happens in the world is that the experts or subject matter experts predict 10 out of the last one crisis, or they predicted 100 out of the last 10 crises. So they keep saying wolf is coming, and you can't just rush out of the door every time someone screams.
Yeah.
So you've had Ebola, you have had SARS, and various kind of Zika and all that. So obviously one has to take precautions, and if one is going to the affected areas, maybe wear masks or try not to go to affected areas and stuff like that. But I was reading the same newspapers as everybody else. I did not have any special insight per se.
So you stayed with what you had. Yeah, you said this too shall pass. The world has been there, done that. So nothing
Yeah.
much.
So, see, we like to say this. So, if we knew that COVID will be so serious and the world will be locked down for almost 2 years, uh, and things like that, maybe we would have sold off everything. But we did not know that it would happen.
Yeah.
Again, did we know in 2008 there would be a global financial crisis? Answer is no.
Yeah.
If you read Stephen Covey and the 7 Habits of Highly Effective People, he says there is a circle of concern and there is a circle of influence. So things like pandemics or wars between two nations and all these are circle of concern. We can't do anything about it. What is under our influence, we can decide which managements to partner with, which businesses and sectors to invest in, what valuation we enter at, how much portfolio weight should be given to individual companies. Those are the kind of things. So we keep focusing on that rather than worry too much about what could go wrong, what could go right, and just go all over the place in terms of tracking numerous variables.
Yeah, I would suspect that kind of an approach would bring so much peace and calm to your workday, right? Because you would just know what to not focus on and what to focus on, and what you're focusing on is something you can influence. You can actually deal with it. So yeah, that's a great thought as well. Thanks for sharing that. On this podcast, we don't discuss anything current. I'm not going to ask you the question that you've been asked 25,000 times. Why do you invest in global stocks? That's not our beat. We're not going to do that. However, I'm going to ask you one question related to unconventional bets, for lack of a better word. Full disclosure, I'm an investor in your fund. So I get to see the fact sheet regularly. And I have a couple of things which I note, I'll mention, and you can correct me or not. One thing I deeply appreciate is that you communicate extremely clearly on what is it you're setting out to do and what is it you're doing. I remember in 2019 or 19, you spoke somewhere and said that you expect your overall cash allocation to reduce over a period of time, or it was, I don't remember the year. Maybe I'm getting the year wrong. And those days used to be 25-30% cash or something. And I saw what you say is what you do very, very clearly. Then you made that famous statement last year, which I loved. I tell it to everyone. We have underperformed. We are underperforming. And at some point in time in the future, we'll underperform. So you're managing expectations. You're being totally transparent, right? So it helps, I think. You've got all your investors, hopefully all of them, on your side in terms of thought process. In this journey that you're taking us, and you're taking a lot of the people, often you make pretty contrarian calls, right? Which typical fund managers may not do. And it's not important which stock it is. So I'm trying to understand, again, it goes back to how do you draw that conviction? Because each of these bets actually ends up being pretty significant in terms of a portfolio. And so that's one. What gives you the conviction of unconventional bets? And second, I have actually noticed that you stick to it and you let it play out. And, as the last so many years have told us, you're usually right. But again, where do you get this conviction and where do you get this willpower to let it play out and all along communicating clearly to everyone?
Sure. So firstly, you mentioned it usually plays out. It may play out, it may not play out. So there are companies where things have not worked the way we would have expected. But that is the nature of the activity that we do. So let us say you and I had a special coin with us, which came heads 70% of the time and was tails 30% of the time. And if you win, you double. If you lose, you give up the money. Then the right approach would be to bet on heads at every toss,
That's
because
right.
it has a 70% probability of making money for you. So that's what we do. In a portfolio of 20 stocks, we select the ones which have a higher probability of going up, lower probability of going down, higher payoff on the upside, lower payoff on the downside. Does it mean that each coin toss will turn out to be heads? No. 30% of the time, it will go against you. So that's the nature of activity. So when we decide on whether to buy something or not to buy something, from first principles, we go with the first question: is this promoter group, management group worth investing with? If the answer is no, we don't invest. Is this sector very, very competitive? So even if it's a high growth sector, if it's a very commoditized business, chances are it may not make a lot of money for the investors. So here we keep in mind Benjamin Graham, who said obvious prospects for physical growth do not translate into obvious profits for investors. So plenty of examples in this space. So private sector airlines, for example, in India, we had Indian Airlines monopoly and it was opened up. Still, most airlines went bust. The telecom sector in India, where earlier MTNL, BSNL were monopoly operators, but a lot of people lost a lot of money in the telecom sector. So we try away from these super competitive sectors. We stay away from very, very leveraged balance sheets. So in the pandemic, let's say if you took two retailing companies, one was very leveraged, the other had cash on the balance sheet. The leveraged company went bankrupt and the one with the cash could actually expand in that period. So we stay away from very, very leveraged businesses. And finally, pay a reasonable valuation. So this is the approach on first principles basis. Now, sometimes that agrees with the market view. Sometimes it's contrarian to the market view. Either way, you have to come to your own conclusion. After we arrive at our conclusion, we act on it and we communicate, as you mentioned, through our fact sheet notes, through our YouTube videos to the community at large, and through our annual meetings. So if there's a fundamental flaw in our thinking, we get feedback from smart investors. Like you are one of the investors. There are 20 lakh other investors. So if a lot of people push back and say that this is the flaw in your thinking, we go back to the drawing board and see whether that makes sense or not. But otherwise, if the facts are in our favor, if on first principles basis, it looks like an attractive investment, we let it play out. And some of them will go wrong just because of the probabilistic nature of investing. But on average, it works reasonably well.
So just to recap, you're looking at the management. So I'll flip it. You're trying to look for the right management, well-managed companies, good capital allocators, do the right thing for the shareholders, etc. You're looking for a sector which is high growth, but also the competitive scenario is such that allows that growth to translate into profits, right? Then you stay away from leverage as much as you can. I'm sure you have thresholds, and then you pay a reasonable valuation or reasonable multiple to buy the business. So simple model. Just take conviction. You have to stick to it. But again, I think the humility you guys ooze is that you're listening still. You may have all the conviction in the world, but you're listening. That did you miss something? And some of the fund managers who've been on this podcast, and it's so appreciative. So one of the fund managers told us that they have an investable universe which they are tracking for years, someone told me one of the fund managers told me he had notes from 20 years ago on a company. So if he met a company, he'd say, in 2002, you told me this and you did it, which I like, but you didn't do this. Why? So the point, I just lost my line of thought. I'm sorry about that. But uh, the the thing the fund manager was telling me is, to get back to that point, that they have the 450 companies. They look at those companies, they track those companies, but when they decide to invest, they don't go all in. They make a small investment and actually see whether their thesis is playing out. So after all that conviction, all that study, but the humility tells them they could still be wrong. So let's see it play out in the real world and then increase the stake. And I thought that's nice, right? You're sort of open to being wrong, and that in itself lays a great foundation from learning, being a learner, and hopefully doing well over time.
Yeah. So in terms of concentration versus diversification, I think that there's a reasonable balance that one can strike. So if you have 100 stocks and if you have 1% allocation to all the 100 stocks, even your best idea may not contribute meaningfully to the portfolio. If that 1% doubles, then still the portfolio return is only 1%. At the same time, if all your money is in one stock, if the stock falls by half, your portfolio falls by half. So when you have 20, 25, 30 stocks, that's a reasonable mix between conviction and risk management. So both need to go hand in hand.
That's right. So what are your thoughts on position sizing? How do you think of position sizing, and how do you ensure that over time it plays to your advantage in from a return perspective?
Yeah, so position sizing, there's a little bit of science and a lot of art in that. So science part is the stock number of 25 or thereabouts, and try and keep them somewhat uncorrelated. So you have sectoral limits and group limits and various other things that come into play. The art part is that sometimes the position sizes are driven by relative stock price movements. So if you have a 4% weightage to a stock and it doubles in a short span of time, it will go up to 8%. So then what do? Do you trim it? Do you let it run? So those are the kind of judgment calls which come about. Also, how much proportion of a company should you own? So you should not own so much that your own entry and exit
drives the price up.
Drives the price up and down. So a lot of those factors come into play. I don't have a formula to give in terms of position sizing, but yeah, I think as long as you have individual company weightages somewhere in the region of 3 to 7, 8%, it should be more or less okay. Again, given the space that we operate in, 10% is the hard limit per stock. So we don't go beyond that in any case.
Yeah. And do you guys look at the index weightages?
Not so much. Not so much.
Yeah, because I would say even that's quite contrarian, because a lot of fund managers would also look at what the weightage in the index is, because that's what they're being benchmarked against. Okay. So let's talk a little bit about the other aspects of the podcast, right? Something which I should have asked you first, but maybe we'll get back. We'll come to it now. Which was your first big investment failure?
First big investment failure, I think, were PSU oil retailers, oil marketing companies.
Oil marketing companies. And this
So
was
this is in the PMS days. In the
PMS days, yeah.
At that time, at the time of buying, the thesis was that these companies have a network which is hard to replicate. So they own petrol pumps in all the major cities, and land is not available in those cities. So on the highways, you may be able to replicate filling stations, but not in the cities. And even on airports, they have these aviation turbine fuel bunkers and all that, and they are effectively locked into those situations. Plus, there was a talk of disinvestment in at least one of the large companies which would have unlocked value. So that was the buy case. And a few years down the line, the privatization did not happen. Crude oil prices shot up, and these companies were being forced to sell fuel at a discount. So the interesting part is that a bull market will hide a lot of sins. So here we did not actually lose money in terms of selling price being significantly lower than buying price or anything like that. Maybe we made a small amount of profit. The biggest loss was in terms of the opportunity cost, where the index went up quite a bit and these companies did not return so much to us.
Yeah, but you could be excused for that because in the 90s, there was this big movement on investing in PSUs because India was changing. They're going to get privatized. They're going to become more efficient.
Oh, I have excuses for all my failures. Don't worry about that. Yeah,
Okay.
I fool myself in terms of all the things which went wrong were the market's failures,
Markets.
and everything that went right was my smartness.
Okay. On that happy note, let's move forward. So we broadly discussed your stock selection process. You already preempted that, and we've spoken about that. One common theme that comes across in multiple episodes of the Investor Hour is the importance people place on the return on capital and the incremental return on capital. What are your thoughts on that? On how much importance to give that point? And because retail investors overlook that completely. They're not looking at return on capital. They're looking at P. They may look at return on equity a little bit, but they're not really looking at incremental return on capital, etc. Your thoughts, please.
Yeah, so a simple way I explain to investors or retailers is that, let us say if I came to you with a proposal where you put in 50 rupees, I will put in 50 rupees, we'll start a business with 100 rupees, and annually it will make a profit for us of 5 rupees or 6 rupees. Would you partner with me in such a business? And typically most people get what I am trying to convey. They would say that, oh, I can get 7.5 rupees in the bank account. Interest rates are 7.5 rupees. So why would we start a business and bother with running it if we are going to make 5 rupees or 6 rupees profit at the end of the year? So I say that is what return on capital employed is. If you as a shareholder put money in a company and the company creates a factory or a network of retail outlets or office campuses for IT services or whatever the business is, telecom towers, leasing aircrafts, if at the end of the period, if on shareholders' money, it is not going to earn maybe 12% or 15% at the bare minimum, why would you even start such a business or invest in such a business? People get that intuitively.
Yeah. But it still surprises me. I don't know whether that's your experience in the interactions you have with retail investors. This is a very ignored fact, point of study, if you will.
Yeah, so where things get confusing is that the share prices don't trade at book value, right?
Mm-hmm.
So let us say there is a business with ROC of 8%.
Okay.
But it is available at 1/4 the book in terms of the share price.
So
on your purchase price, you are maybe getting 32%.
32%.
Right? And a business with a ROC of 20% or a ROE of 20%, that is available at 10 times book. So on your purchase price, you are getting 2%. So that's where the P ratio comes in, or reverse of P ratio would be the earnings yield. So the high ROC, high ROE businesses never trade close to book. And that's where the thing gets interesting and challenging. How much should you pay up for the opportunity of reinvesting capital at a high ROC and things like that? And it takes a lifetime to learn that. That is not something which is easy. Otherwise, it's very simple. If all equity is available at book value, then you select the one with the highest uh, return on equity.
Yeah, that's a very interesting point. That's thought-provoking. Yeah. Well, if it was that easy, just look at the return on capital, then a lot of problems would be solved in life. Okay, thanks for that. Moving on. We spoke about how to pick a stock, what do you look at, the various parameters, etc. When do you decide to exit a stock?
So if the business model changes, or if the fundamental assumptions that went into a investment thesis, if those turn out to be wrong, you have to exit it. Whether you are making a profit, making a loss, doesn't matter, because your approach is wrong. And even at the current market price, if the investment does not make sense, one has to go to the exit doors. If it's a temporary issue, if there's a one-off event, let's say if you are in the hospitality space and there's a weather-related event where there's flooding in that area or something, and it is going to be a 1 quarter or a 2 quarter problem, then obviously you wait out for the situation to normalize. If it's a valuation thing where valuations are increasingly becoming expensive, then it's not a one-shot exit. We tend to reduce our weightage over a period of time, maybe months, maybe quarters. And if valuation keeps going up and it moves beyond the comfort range, then we may completely exit a stock.
Okay. What do you do with stocks where you have conviction, but they don't move in price?
Typically, we tend to wait. So we have been patient. So if it takes a very, very long time, let's say 5 years, nothing happens to the stock price or to the business, both, then obviously something is wrong in our thesis. But otherwise, we tend to wait a reasonably long period of time, 3 years, 5 years.
Wow, that's quite some waiting. But all along you're tracking the business. So business is doing well, price is not reflecting. So okay, we'll wait it out. Yeah, I like that approach. It's a better version of buy and hold, because or buy cheap and hold and wait for the market to correct. Here you got a good business because the markets are not recognizing, but you have to be sure of your research. I think you have to have a high conviction and you wait it out. How do you detect fraud, or how do you prevent yourself, or how do you prevent being caught in a fraudulent situation? Or have you been caught before once in such a stock? And if you can share an experience.
So I don't think we have been in situations of out and out fraud. So we haven't fortunately had a Satyam kind of situation where the cash was not there. But typically there are various books which are written on this subject matter, and these days a lot of data is available. Some of the portals do it on a subscription basis for you, in terms of give you data on the number of employees, whether provident fund is being paid on time or not, whether GST is being paid on time or not, red flags in terms of frequent auditor changes or director changes and stuff like that. But otherwise, basically, we go on the basis of the audited financials and the notes to accounts and things like that. Some work may happen in terms of the channel checks and stuff like that, but nothing is 100% foolproof. So someone who's very, very motivated in terms of defrauding investors may still get by. But by and large, so far, we have not had too much by way of losing money in terms of fraudulent situations. In one company where we had invested, When we invested, it was a services company where their payment would come upfront, even before the services are given, and negative working capital business. But then, soon after we bought the company, they changed their business model in terms of going in for some capital expenditure, and where revenue would come back ended and things like that. So we did not think it was a fraud at that time, but we felt uncomfortable with the changed business model and with the way the balance sheet started looking, and we exited the company soon after. Did not make much or lose much, so it was a pretty quick entry and exit. But that company later on went to the cleaners. So
Okay.
whether a fraud was involved or it was just bad business decision making, or that is subjective. But yeah, we got saved in a couple of cases where we exited when we saw warning signs.
Mhm. Okay. Now, talking about you personally, what are your thoughts on asset allocation?
I think people should do what is according to their life stage and needs, and according to their risk appetite. So obviously, 25%, a 25-year-old in a government job should not have 100% of the money in savings bank account or in a liquid fund. That person has job security and a long career ahead. It should be skewed towards equity. And a 80-year-old retiree needing monthly cash flows to meet expenses should not be equity heavy. So there are some of the obvious examples, but what also matters is how much comfort you have in terms of it being in volatile assets like equity. So partly it's driven by personal attitudes and personal tolerance of volatility.
Yeah. Okay. What are your thoughts on real estate, gold, and other asset classes forming part of the allocation?
So real estate gives some diversification as compared to equity. It comes with its own challenges in terms of it being not divisible. So you can either buy a house or not buy a house. If you have 10% of the money, you can't say, I want to own 10% of this house or this office block or things like that. That's as far as direct real estate investing goes. Plus, transaction costs are high, stamp duty and all that. It requires upkeep, so you need to negotiate with tenants and pay municipal taxes on time and do the repairing work and all of that. So with the recent introduction of REITs in India, at least in the commercial real estate space, that problem is somewhat taken care of. So it can be a good source of diversification for people who want some assets apart from equities. Gold as such is an asset class with no cash flow unless you are buying the sovereign gold bonds or things like that. But it is protected against currency devaluation over the years, or it has been protecting some amount of purchasing power or most of the purchasing power. In India, most people are having gold in the form of jewelry, which is passed generation to generation. So I don't think people have a huge need to buy gold separately, but some people may choose to have a portion of their wealth in gold as well.
I think in a country like India, which is always capital hungry, which will import capital for long to come, which implies a weaker currency over time, and that's what history has told us also. Gold is just such a nice hedge for a weakening currency. I think, if I'm not mistaken, most of the return in the gold rate for Indians is the depreciation of the rupee.
Yes.
Gold was what, $800 in 1977, 78. It's $2,000 now. So in this amazing period of 40 years or 50 years, it's just gone up 2.5 times, 150%. but in rupee terms, there's a jackpot. So, okay. Moving on. So, Rajiv, you have kids?
I have one daughter.
Daughter. Okay, great. Wonderful. So, how are you teaching a daughter about money, or how are you introducing her to the world of investing and money?
Okay, so she knows what I do for a living.
Okay.
She's heard me talk about basics of finance to undergrad students, and she's come with me to Omaha, Berkshire meeting a couple of times.
Nice.
Academically, she's in the first year of her computer science engineering. So right now, it doesn't seem like she'll pursue a career in finance, but who knows down the line. But she's aware of what I do, the power of compounding, the power of saving and investing and stuff like that.
Oh, nice. So you're not facing the issue that, or rather, you have advantage because grandfather did it, father did it. I might as well know some of it. Huh?
Yeah. I expect her to be able to manage her finances properly.
Good, good. I was also going to say that uh, she's doing engineering, which dramatically increases her chances of managing money because a lot of the engineers ultimately end up as money managers. Okay, so that's nice. Your thoughts on giving away wealth?
It's a personal preference. There are some people who are in this constant race to upgrade lifestyle as they live. So, if you have a bike, you want a car. If you have an entry level car, you want a compact SUV to a large SUV to a Rolls Royce to, and there's no end to it.
That's right.
So, whether you believe in this study or not, where the personal happiness and satisfaction peaks out at a certain income and wealth level, I believe that. So, in the initial stages, more money gives you more happiness because the basic discomforts of life get taken away. You get a good place to live, you get a good vehicle, you have adequate risk covers in place, and your mind is at peace because of financial security. But then, if you are on that what is called a hedonistic treadmill, where you want a new high every time and you want something bigger and better all the time, then that doesn't bring happiness beyond a time. So, to my mind, whatever is required for personal financial security, personal consumption needs is there, and whatever is surplus should be recycled for good of the people.
Yeah, that's a nice thought. How much time do you spend reading?
Most of the working days reading.
Several hours, 5, 6, 7, 8 hours a day,
Yes.
just reading. And what do you typically read? Annual reports, books, magazines?
A variety of things.
Yeah.
All of these.
Any global publications you read which you think helps you become a better formed investor?
So earlier there used to be this thing of bundled content, right? So either you subscribe to one magazine or you did not subscribe to that magazine or a newspaper. Same with cable TV channels. You were subscriber to Z or not subscriber to Z. But these days, there is streaming in all sorts of media. So you can read one article from The Economist, one article from Wall Street Journal, and really you have to curate your information. So I'm not so much driven by publication. Sometimes the reading could be just a blog where you are following someone, or it could be a Twitter feed or something like that. So it's more about curating and filtering the content based on the interest areas.
That's a very nice thought. Typically, I ask for publications, but that's nice. You can actually read by piece. You curate what you want to read and read it wherever it's available. That's a nice thought. Okay. I want to talk to you a little bit about India. And I also want to talk to you a little bit about Parag Parikh. So let's start with Parag Parikh. Tell us a few things that you think are his core values, which could help someone be a better person, better investor, better stock picker.
So one obvious thing was anyone who knew him for any length of time knew that he had interests beyond work. So it was not that he was trying to become the richest person and do work all the time, or to seek new clients all the time, or to seek the next investment idea and things like that. So he took up singing, he took up playing a musical instrument. He would spend time for his swims and for meeting friends and for travel. So work-life balance was something that one learned from him. I got introduced to the Vipassana meditation by him, the subject of behavioral finance and the need for keeping your emotions under control, both in good times and in bad. So these are the learnings. Again, we spoke about the uh, giving back, or the custodian principle, or the hedonic treadmill. So why not to hanker after lifestyle upgrades all the time, and why to uh, be content with what you have and stuff like that. So he was a multifaceted person, and there were a lot of learnings in terms of interaction with him.
Yeah.
The other thing which it's very, very difficult to replicate is the kind of a people person that he was. So sitting next to virtually any employee in the person, in the organization, and uh, being able to figure out the emotional pulse of that person, and one look at you and he could figure out how you were feeling. If you were down and you did not have to say a word, he would immediately get to know that something is wrong, and he would talk to you, trying to figure out what is wrong and help you out in some way. Something that would not be considered politically correct these days, but if he thought that you were not taking care of your health, you were becoming overweight or something, he would fat shame you, saying your tummy is coming out, please control your diet and start exercising. So he was very particular about people taking care of their health.
He was very involved with the people around him,
Yes.
which is nice. Nice to know. A little bit about India. So India has had multiple starts, right? One of big start was 91, 92, the reforms. Lots has changed since then, but a lot of people also say there was like a start which ultimately stuttered, sputtered, whatever you call it, and sort of we went into a phase where nothing much happened. Now people believe there's genuinely change, and they can actually see India doing a whole bunch of things in the years to come. Now, the way you run your fund, you're a bottom-up stock picker. So you don't have a theme per se in that sense. But from your perspective, how are you seeing India today? And if you and talk to us and tell us how we should think of India, or what we should look for, and how it should inform us about our decisions we make in our investing in time to come.
As a citizen, I think there's plenty to be happy about. So, as we say, we are in Azadi Ka Amrit Mahotsav, 75 years. If we look at our own region, where a lot of countries became independent virtually the same time. So if we look at Sri Lanka, Pakistan, Bangladesh, Myanmar, Nepal, or the entire neighborhood, we seem to be doing reasonably okay. You mentioned stops and starts and things like that. That's part and parcel of every country's journey. But broadly, we seem to be doing okay. We are improving in terms of the literacy, in terms of the access to sanitation, in terms of access to food, shelter, clothing, infrastructure. All those are positives. We have demographics on our side, where we have a young population. Globally, also in terms of geopolitics, there is this concept of friendshoring, where people don't want to invest with autocratic governments or very belligerent governments. So broadly, things are going our way. Does this have too many investment implications? I'm not so sure. So you mentioned being bottom up stock picker or things like that. Just step back and think about it. Global commodities, be it steel, aluminium, crude oil, uh, does it matter which country you are in? So ONGC will get the same price per barrel as what a oil company anywhere else will get for the same quality. So what depends on how much production they are able to make, reserves to production ratio and things like that, which have nothing to do with the country's economic growth or policies or things like that. So metals, primary commodities, these are linked to the global economy and the global prices. Same way, a lot of our listed universe supplies to the export market. So all the IT services, the pharma basket, and so on. A lot of companies have made huge acquisitions abroad. So Tata Motors is not just about the Indian car market, it's about a Jaguar Land Rover. Bharti Airtel is about their African operations. Hindalco is about Novelis. So we have a lot of these interlinkages. So increasingly, no country is operating on its own. We live in a interconnected world. We live in a globalized world. So yeah, one has to look at opportunities wherever they arise. And an interesting piece of research has been done, and viewers of this can Google this up. So it's a study on the correlation between GDP growth rates in a country and the stock market returns. So the correlation actually came out to be 0 to mildly negative. So again, if we look at a country like China, it has had good GDP growth over the past few decades.
Yeah, terrible return now.
But the equity returns to investors have not been that stellar. So if more aircraft are leased out and more flights are run, more passengers are transported, does it mean GDP growth? Answer is yes. Does it mean more profits to airline shareholders? Not necessarily. So again, coming back to the point, obvious prospects for physical growth do not translate into obvious profits for investors.
Yes.
So one has to take into account a lot of other business factors, competitive intensity, pricing power, those kind of things, apart from just the GDP.
I like the way you framed it. As a citizen, it's much better. But when it comes to stock picking, there's so many more things you have to take into account. Rajeev, we are out of time. One final word from you, a message to all the viewers and listeners.
Happy investing.
Wonderful. On that note, Rajeev, thank you very much. I know you're super busy. You took out the full 90 minutes we asked for. Thank you, thank you, thank you.
Thanks a lot.
Wonderful.